You know, the market doesn't forgive carelessness. It punishes it. Every tick, every swing, every flash on that tape carries a message, and if you ignore the message of risk, the market will teach you a lesson you'll never forget. In our last talk, the previous video on the hidden power of support and resistance, we spoke about how the market builds its walls, where price finds strength, where it breaks down. Today, we're going deeper into what happens when a trader forgets the one rule that keeps him alive in this business: risk management. Now, let me tell you something that I've learned through pain, not theory. It's not the bad trades that ruin a trader, it's the bad habits. Losing is part of the game. Ignoring risk is suicide. You can survive 1,000 small losses, but you can't come back from one uncontrolled one. Have you ever had a trade go against you, and instead of cutting it, you thought, "It'll come back"? You probably smiled when it did once or twice, but the third time it didn't, and that's when the market took more than your money. It took your discipline. Risk management isn't a fancy term. It's the lock on the vault that keeps your capital safe. A trader without a stop loss is like a ship without a rudder. You may float for a while, but when the storm hits, and it always does, you'll go under. The market doesn't care about your opinions, your hopes, or your analysis. It respects only one thing: control. You either control your losses or your losses control you. Tell me, which side of that do you want to be on? Most traders lose not because they can't read charts, but because they can't rid themselves. Greed whispers, "Hold it a little longer." Fear screams, "Don't take that next trade." Both are lies. The market rewards balance, courage with caution, patience with precision. I've seen men ruin themselves because they refused to take a small loss, only to end up taking a massive one. And yet, every successful trader I've known had one thing in common. They treated risk like a cost of doing business, not a personal failure. Let's get practical. Every position you take should have a reason to exist and a plan to die. Before you click that button, you should know where you'll get out, both if you're right and if you're wrong. Never leave that decision to the heat of the moment. The tape moves fast, and emotion moves faster. You can't trust either when your money's on the line. How many times have you watched a small loss turn into a disaster simply because you couldn't accept being wrong? And here's the truth. Most traders don't plan to blow up. They simply fail to plan not to. Risk management is not about fear. It's about staying in the game long enough to catch the right move. You can't ride the big waves if you drown in the first storm. When I used to trade the bucket shops, I learned that it wasn't the size of the profit that mattered. It was the size of the drawdown I could survive. The market gives opportunities every day, but it gives no mercy to those who run out of capital. Remember how we talked about support and resistance? Those zones mark where buyers and sellers show their hand. Well, risk management is the same principle applied to your own trading. Just like price respects its boundaries, you must respect yours. When price breaks a level, the chart tells you something has changed. When your loss hits the limit you set, it's telling you something too. Ignore it, and you're not trading anymore. You're gambling, and in gambling, the house always wins. Some traders think they can outsmart risk. They add to losing positions, hoping to average down and claw back what's already gone. That's not skill, that's denial. I've done it, and it always ends the same way: regret. A real trader adds only to winning positions, never to losers. Because when a trade works, it confirms your idea. When it doesn't, it's the market telling you to move on. Why argue with the only thing in this world that's never wrong? You see, risk management isn't about playing small. It's about playing smart. It's about capital preservation, because without capital, there's no opportunity. Your first job as a trader isn't to make money, it's to protect the money you already have. Only when you learn to protect it do you earn the right to grow it. Every dollar in your account is a soldier. Send them into battle only when the odds are in your favor. Don't waste them on hope. You ever notice how the best trades are usually the ones that feel the hardest to take? That's because real discipline isn't about excitement, it's about control. The market will tempt you test you, tease you. It'll make you feel invincible on Monday and bankrupt on Friday. That's why your rules matter more than your feelings. Your emotions belong at home, not on the trading floor. And here's something I learned after years of watching charts. The best setups in the world mean nothing without a safety net, a support level, a stop, loss, a position size that fits your capital. That's your real edge. Not the indicators, not the rumors, not the news. Risk management is what turns knowledge into longevity. You can have the best entry, but without the right exit, it's just a ticking bomb. If you ever want to build wealth through trading, not just make a quick buck, you've got to think in terms of preservation first, multiplication second. Protect the principal, and the profits will follow. Most people do it backward. They chase gains and end up chasing losses. Don't do that. Build your base, brick by brick. Because wealth, like trading success, is built not by luck, but by discipline and patience. And as you're listening right now, maybe you're thinking, all right, Jesse, I get it. Cut losses, manage risk. But let me ask you this. Do you really do it every time? Or only when it's convenient? That's the difference between a professional and a pretender. A professional knows that one careless trade can undo months of hard work. He doesn't let that happen, no matter how tempting the setup looks. See, the market isn't your enemy. It's your mirror. It reflects your habits, your patience, your control. If you trade recklessly, it'll show you chaos. If you trade with discipline, it'll show you opportunity. Risk management is the line between those two reflections. Ignore it, and you'll spend your days chasing the market instead of reading it. Think about this. Every major level on a chart, every resistance, every support, is a story of traders who respected or ignored risk. Those who set their stops survived to fight another day. Those who didn't became part of the pattern, another data point for the next trader to study. That's how the market keeps its rhythm. That's how it weeds out the weak and rewards the patient. Risk management is the foundation, not an accessory of successful trading. That single truth separates the professional trader from the amateur dreamer. Most people come to the market thinking about profits, about how much they can make in a day, a week, or a month. But the professionals, those who last, think first about how much they can lose. Because in this game, survival comes before success. You can't make money if you're out of the game. The market gives opportunities every day, but only to those who are still standing after the storm passes. I've seen countless traders come and go. They all started with excitement, full of confidence, armed with indicators, strategies, and the latest market theories. But do you know what most of them forgot to bring? A plan for when things went wrong. That's the irony of trading. You can be right 9 times out of 10, and the 10th can still wipe you out if you've ignored risk. Tell me, what good is a perfect entry if a single bad trade can destroy your account? That's why risk management isn't something you add later. It's the very ground you stand on. Think of trading like building a house. You wouldn't start with the roof, would you? You'd start with the foundation. That foundation isn't glamorous. It's just concrete and steel. But without it, the house crumbles. Risk management is that foundation. It's the structure that holds your strategy, your mindset, and your money together. Every system, every method, every technical setup must rest on it. Otherwise, it's only a matter of time before it collapses under pressure. When traders ignore this foundation, they chase excitement instead of stability. They focus on profits and forget that trading is about probabilities, not guarantees. The best traders aren't those who win the most. They're the ones who lose the least when they're wrong. Losses are part of the business, but unmanaged losses are poison. You can recover from a small wound, but a deep cut takes you out of the fight. How many times have you told yourself, just this once, I'll hold a little longer, only to watch your small loss grow into a disaster? That's the price of trading without a foundation. Risk management means knowing where you stand before you even step in. It's understanding your exposure, your limits, and your pain threshold. Every trade should be a calculated risk, not a guess. You decide how much to lose before you decide how much to gain. That's how a professional thinks, Amateurs trade for thrill, professionals trade for survival. And that survival comes from structure, from treating risk as the core of your method, not an afterthought. A trader without a plan for risk is like a pilot flying blind in a storm. You might get lucky once or twice, but eventually the clouds close in. The tape starts moving faster, and before you know it, your judgment turns to emotion. That's when panic takes the wheel. You can't rely on luck in this business. You can rely only on preparation, and preparation begins with protection. Every decision you make should start with one question. How much can I afford to lose on this trade? Not, how much can I make? That's a dangerous way to think. The professionals understand that their capital is their ammunition. Lose it, and the game's over. That's why they guard it fiercely. They don't risk $1 without a plan to get it back if things go wrong. They don't fall in love with trades or ideas. The market doesn't care about your feelings. It rewards discipline and punishes ego. Have you ever noticed that the moment you start believing you can't lose, that's exactly when you do? That's the market's way of reminding you who's in charge. Every trader needs rules, non-negotiable, unbreakable rules about risk. It could be a maximum percentage per trade, a daily loss limit, or a stop-loss level that's never moved. Those rules are your insurance policy. Without them, your emotions will run wild. And once emotions enter the picture, logic leaves. The tape moves faster than thought. The only way to stay ahead is to decide your limits in advance. You'll thank yourself when the market tests your patience and tries to pull you off your plan. And let's talk about something most traders don't like to admit: fear. Fear is the silent partner in every trade. You can't get rid of it, but you can manage it. Proper risk management doesn't eliminate fear, it contains it. When you know your downside is limited, you trade with clarity. You think objectively. You make better decisions. The worst enemy of a trader isn't the market, it's uncertainty. Risk management removes uncertainty. It gives you control, even when the chart doesn't cooperate. You know what's interesting? The traders who focus most on risk usually end up making the most money over time. It's not because they have magic strategies. It's because they survive long enough to see the market's cycles play out. While others blow up chasing the next big move, they're still in the game, compounding their capital trade by trade. Consistency beats intensity every time. That's the difference between luck and longevity. If you watched the previous video on the hidden power of support and resistance, you remember how we talked about structure, how price respects certain levels, because that's where power shifts between buyers and sellers. Risk management is the same thing but applied to yourself. Just like price has boundaries, you must have boundaries too. When you break them, the consequences are just as real as a market breakdown. Respect your limits, and your capital will respect you back. A trader's mindset must be built on respect for the market and protection of capital. You can't control the outcome of any single trade, but you can control how much it costs you when you're wrong. That's your real power. The market rewards those who stay humble, who accept that losses are part of the game. You don't fight the market, you flow with it. And flowing with it means knowing when to cut, when to pause, and when to walk away. The foundation of risk management isn't complicated. It's discipline, consistency, and humility. It's setting rules and following them, no matter what your emotions scream. It's about seeing trading not as a get-rich scheme but as a long-term business. You wouldn't run any other business without managing costs. So why trade without managing risk? Every loss you control is a win in disguise, because it keeps you in the game for the next opportunity. When traders finally understand this, something changes in them. They stop chasing every candle, every rumor, every signal. They start trading less but earning more, because they've learned that success isn't about finding the next big move. It's about surviving the wrong ones. Risk management isn't a tool in your kit. It's the foundation of the whole house. Without it, every other skill you have eventually crumbles. Every trade must have a defined exit before it begins. That's the golden rule most traders learn too late. You can have the best entry in the world, the perfect signal, the cleanest setup, But if you don't know where you're getting out, you're not trading. You're just gambling with a chart in front of you. The market doesn't reward courage. It rewards preparation. A trader without an exit plan is like a pilot who takes off without knowing where the runway is. It's only a matter of time before the sky turns dark and panic sets in. When I say defined exit, I'm talking about both sides of the trade, your target and your stop. Before your finger even touches the buy or sell button, you should know where you'll get out if the market proves you right, and where you'll get out if it proves you wrong. The second part is what separates professionals from amateurs. Anyone can imagine the profit side. Only the disciplined think about the loss side. Have you ever noticed that it's easy to plan how much you'll make but uncomfortable to decide how much you'll lose? That discomfort is where most traders fail. They'd rather ignore it than face it. Trading without an exit is emotional trading. You start out with logic and end up with hope. The moment price moves against you, you start reasoning, adjusting, convincing yourself that maybe the trend will turn. Hope becomes your strategy, and that's a dangerous position to be in. The market doesn't care what you hope for, it moves where it wants. Every tick that goes against you without an exit plan eats away at your confidence. One trade without a stop can undo months of discipline. That's why the best traders always define their exits in advance. They refuse to let emotion make decisions for them. You can think of your exit as your insurance policy. You don't buy insurance because you expect disaster. You buy it because you respect the possibility of it. A stop loss is that insurance. It's not there to hurt you. It's there to save you. Some traders see it as a limitation, a cage around their potential profits. But the truth is, it's what keeps you free. It gives you the freedom to trade again tomorrow, to stay calm when others panic, to make decisions based on reason instead of desperation. How many traders have you seen blow up accounts because they refused to take a small, planned loss? Setting a target is equally important. Knowing where to take profits keeps greed from clouding your vision. Without it, you'll always wonder if you sold too early or too late. You'll second, guess yourself after every move. A defined target gives you closure, a finish line. When the trade reaches it, you take your reward and move on. You don't argue with the tape, you respect it. Remember, your goal isn't to catch every tick of the move, it's to consistently extract a piece of it, over and over again. Professionals don't need to catch tops and bottoms, they live off the middle. Some traders argue that the market's unpredictable nature makes fixed exits useless. But that's exactly why they're necessary. You can't predict the future, but you can plan your response to it. You can't control the market, but you can control your risk. That control begins and ends with your exits. Every trade is uncertain. Your exit plan is what turns uncertainty into structure. Without it, you're reacting to every tick instead of following your own rules. You ever notice how easy it is to plan a trade on paper, but how hard it is to follow it when money's on the line? That's the battle between discipline and emotion. The chart doesn't change. You do. You see red on the screen and your logic disappears. You start moving your stop, just a little lower, telling yourself you'll cut it next time. But next time never comes. The loss grows and so does your frustration. That's why defining your exits in advance is not optional. It's survival. You set it, you honor it, no matter what. Having a clear exit also gives you clarity in position sizing. You can only calculate proper size when you know how much you're willing to risk. If you don't know your stop, you can't know your exposure. That's why traders who skip this step end up over-leveraged and underprepared. The market doesn't destroy them. Their own lack of planning does. You can have a string of good trades, but it takes only one without a defined exit to take it all away. If you think back to the previous video on the hidden power of support and resistance, we talked about how the market respects levels. How price reacts where strength or weakness lies. That concept ties directly to your exits. A good trader often places stops just beyond meaningful support or resistance levels, not randomly. The market structure itself tells you where your risk should be defined. When that level breaks, it's telling you something your idea is wrong. The power balance has shifted. Respect that message. Getting out there isn't weakness, it's wisdom. There's a kind of peace that comes with trading by plan. You stop worrying about what might happen because you already know what you'll do when it does. You stop staring at the screen, frozen by every fluctuation, because your decisions are already made. You stop feeling like the market is against you, because you're no longer reacting, you're executing. That's what discipline feels like. That's what control looks like in trading. The beauty of defining exits before entries is that it trains your mind to think in probabilities, not possibilities. You stop asking, what if I win? And start asking, what's my risk if I lose? That shift changes everything. You're no longer chasing perfection, you're managing outcomes. It's not about being right, it's about being consistent. Consistency comes from following the same logic every time, no matter what the market tempts you with. One of the hardest lessons I learned early on was this: the market doesn't owe you a chance to get out at a better price. When it moves fast. You blink and the opportunity's gone. That's why you never leave your exit to emotion or timing. You define it before the trade begins, and you let the market do what it does. Your job isn't to predict, it's to prepare. Preparation means knowing both your reward and your risk before you ever enter the ring. Every trade is a decision between discipline and disaster. When you define your exits, you choose discipline. When you ignore them, you choose to roll the dice. The market will test you every day, pushing you to bend your rules, to move your stops, to chase just a little more profit. But every time you give in, you trade control for chaos. The strongest traders aren't those who win the most trades. They're the ones who refuse to lose control. Defining your exit before your entry is how you stay one step ahead of both the market and yourself. Protecting capital comes before multiplying it. That's the first rule any trader who intends to last must understand. Most beginners come into the market thinking only about how to grow their money. They want to double it, triple it, turn a small account into a fortune. But they forget that before you can make money, you must learn how not to lose it. The traders who survive, and eventually thrive, are not the ones who chase profits, but the ones who guard their capital like treasure. Because in this game, capital is not just your money, it's your freedom, your opportunity, your ticket to stay in the game. Lose that, and nothing else matters. Every successful trader I've ever known shared the same mindset: defense before offense. They understood that trading is a business, and in any business, you manage costs before you chase revenue. Your losses are the cost of doing business. Your profits are the result of managing those costs better than the next person. Have you ever noticed how the market always seems to reward the cautious more than the reckless? It's not luck, it's math. A trader who protects his capital has time on his side. A trader who risks too much has time against him. When your drawdowns are small, your recovery is fast. But when you take a large hit, it can take months or years to get back to even. Protecting capital starts with respect for risk. You can't control what the market does, but you can control how much you expose yourself to it. That's why professionals always think in percentages, not dollars. They don't ask, how much can I make? They ask, how much am I willing to lose? That mindset shift changes everything. When you size your trades based on risk, not greed, you stay steady. You stop chasing every move and start waiting for the ones that matter. You stop reacting emotionally and start thinking strategically. Tell me, have you ever taken a big position just because you felt confident, only to watch that confidence turn into regret? That's what happens when capital protection takes a back seat. There's a certain pride in being cautious in a market full of gamblers. The crowd wants fast action, quick wins, excitement. But the professional trader knows that boredom is profitable. Boring trades are controlled trades. You don't need fireworks to make money. You need patience and preservation. When you protect your capital, you're protecting your ability to think clearly. Nothing clouds judgment faster than desperation. Once you start trading from a place of needing to make back losses, you've already lost the battle. The market smells desperation like blood in the water. Think of your capital as your army. Every dollar you own is a soldier on the battlefield. Would you send them into a losing fight just because it looks exciting? Or would you wait for the right conditions, the right terrain, the right moment to strike? The best generals win wars not by charging blindly, but by preserving their forces until victory is probable. A good trader does the same. You win not by fighting every battle, but by fighting the right ones. Protecting your capital gives you the patience to wait for those moments. One of the hardest truths to accept in trading is that sometimes doing nothing is the smartest move you can make. Sitting on your capital while the market behaves irrationally isn't weakness, it's wisdom. There's a cost to every trade, not just in money, but in mental energy and focus. By protecting your capital, you protect your clarity. You're ready when the next clean setup appears, instead of being exhausted from chasing every flicker of price. That discipline creates longevity, and longevity is what separates the trader who makes a living from the one who loses a fortune. Remember in the previous video on the hidden power of support and resistance, we talked about how the market builds its walls, how price respects those invisible zones of power. Protecting capital works the same way inside your trading account. Your stop, loss, your position size, your rules, they're your internal support levels. When you break them, your structure weakens. Just as price collapses when support gives way, your equity curve does the same when you stop respecting your own boundaries. The market doesn't destroy traders, their lack of self-control does. Protecting capital also means protecting your confidence. Every unnecessary loss chips away at the belief that you can trade successfully. Once your confidence erodes, you start second, guessing every decision. You hesitate on entries, exit too soon, or hold too long. The spiral continues until trading becomes an emotional roller coaster. But when you guard your capital, you guard your state of mind. You start to view losses as manageable, not catastrophic. You stay calm, detached, and ready for the next move. A trader with confidence and capital is dangerous. A trader with neither is done. Many traders misunderstand what growth really means. They think multiplying capital is about making more trades or taking bigger risks. In truth, it's about making better decisions. Protecting capital is the foundation of compounding. You can't grow something that's constantly being damaged. If you lose half your account, you need a 100% gain just to break even. That's why protection always comes first. Small, controlled losses are recoverable. Big, careless ones are not. Compounding only works when your base remains intact. There's also a psychological side to capital protection. When you know your downside is limited, you think differently. You trade without fear because you've already accepted the potential loss. That clarity allows you to see the market for what it is, not what you hope it will be. Fear makes you sell too soon. Greed makes you hold too long. Capital protection balances the two. It gives you freedom to follow the plan instead of emotions. That's when trading becomes professional. Not impulsive, not reactive, but deliberate. Most people think traders fail because of bad analysis. But more often, it's because they let a small loss turn into a disaster. They didn't set a stop, or they moved it, just one more tick. That's how accounts die. One act of denial at a time. You can be wrong half the time and still make a fortune if you manage risk. But you can be right most of the time and still go broke if you don't. The difference is capital protection. It's not about being right, it's about staying solvent. Protecting capital is about longevity. It's about giving yourself another chance tomorrow. It's about staying calm when others panic because you've already limited your exposure. You don't have to predict what the market will do next. You just have to make sure it can't take you out of the game when you're wrong. That's how you last long enough to see your edge play out. The traders who build wealth over years don't have magic formulas. They have rules that keep them alive when others self-destruct. A trader who learns to protect capital first eventually earns the right to multiply it. That's the natural order. You learn defense before offense. You learn to survive before you learn to expand. Every dollar you save through discipline becomes a seed for future profit. And those who understand that protecting capital comes before multiplying it never run out of opportunities, because the market always rewards those who are ready to trade another day. Risk management transforms knowledge into consistency and survival. Every trader can learn how to read a chart, spot a pattern, or understand an indicator, but without risk control, all that knowledge means nothing. The market doesn't reward the most intelligent person, it rewards the most disciplined. You can know every technical pattern in existence, but if you don't know how to manage the downside, you'll end up broke with a head full of theory. It's not the amount of information that keeps you alive, it's the way you use it. And in trading, using it wisely means protecting your capital through structured risk management. When I started, I believed knowledge alone was the key. I studied every chart, every signal, every rumor that came across the tape. I thought if I just understood the market better, I'd win more. But over time, I realized that understanding is only half the game. The other half is control. Control of position size, control of losses, control of emotion. Because in this business, no amount of knowledge can save you from one reckless trade.